gold's record rally isn't showing signs of slowing down, having its best month since October as investors gain more optimism around rate cuts to come this year. But our next guest says the rise could be premature. Stefano Pascale, Barclays equity derivatives strategist, is joining us now. And Stefano, thank you so much for being here. I can't get over the performance that we're seeing of gold layered next to Bitcoin because it just looks like they are exactly layered on top of each other, and one of them seems like a risk-on vibe and the other seems risk-off. Help me understand how this market is having both of those dynamics play out at the same time.
Yeah, sure. Thanks for having me in the show. So obviously gold recorded really a rally for the books. So the 7% rally that we've seen over the past month has been higher only 6% of the time over the past 10 years, right? But it's not only the extent of the rally really that's been impressive, it's also been essentially the persistence and the strength. So just if you consider that gold has been recording 9 consecutive daily positive returns, that's only happened a bunch of times in the past 50 years. Like that's one of the highest up streaks for gold. And so the intensity kind of suggests that there's something else other than fundamental drivers sort of at work here. And we do think that it's sort of also linked to technicals. So, for example, if you look at the bonds rally and the sell-off in USD, I mean, famously, the US dollar and yields are 2 mechanical drivers for the yellow metal. There were obviously some important tailwinds behind the rally in gold, but they do not explain the full story, right? So, for example, our model shows the yields and the US dollar should have accounted for only 1/3 of the actual rally that happened. So there's something else at work. Now, we did some positioning analysis, and basically there's a strong evidence that the Fed pivot sort of forced macro funds to switch from having a negative exposure to gold to a positive exposure. In other words, sort of the prospects of the first cut forced a lot of macro funds out there to cover their short positions, right? Now, in a way, we think that the macro environment is supportive for gold. I mean, we do think that there's going to be a first cut in June. And if you look historically, gold has done pretty well around the start of a cutting cycle. However, we do caution a little bit here because we think that gold is running a little bit ahead of itself. Yeah. So that's a very interesting stat that shows, since 1980, gold tends to be muted ahead of the first cut. In fact, it only rallies after the first cut has been already delivered.
Yeah, so then
that's not the case right now.
Yeah, Stefano, then how much is that already fully priced in? And then that also begs the question, if we don't get that rate cut when the market is expecting, are we actually going to see some downward pressure then on gold in the near term?
Yeah, I think that's fair. So obviously part of the rally has already happened, which is why we're calling for caution. So, typically the rally that happens after the start of the cutting cycle is about 10%. And so we're almost already there, right? There may be some more upside room left, but, obviously compared to history, a lot of the rally has already happened. So one thing you can do actually, instead of waiting for a better entry point, which is, famously very hard to time the market, one alternative is to actually use options, right? So, for example, the strategy that we are recommending is to gain upside exposure via call spreads. I mean, that strategy, obviously, the advantage is that for a price, it has some sort of insurance built in. So you have upside exposure, but you're not exposed to the downside. And right now, I think volatility markets are really giving you a really good entry point for that type of strategy.
Stefano, we have less than a minute left here. I'm just curious, who is the buyer for gold right now? What is that profile looking like?
If you look at the market through different segments of investors, it does look like retail investors have been absent from the recent rally. So we actually seen a lot of outflows from gold ETFs. On the other hand, macro funds, they switch from being short to now being long. And obviously, the other big players are central banks, which have been big buyers now for many months in a row.